Since September, 111 million ounces of physical silver have quietly disappeared from New York vaults. Not lost, not misplaced, moved. And right now, COMEX registered holdings sit at just 88 million ounces, while the market needs 30 million a month to function. You do that math, and something breaks before spring. Meanwhile, Shanghai is paying $9 over spot every single day. That spread alone covers shipping, insurance, and still leaves profit on the table. So ask yourself one question. If supply was fine, why is silver leaving New York at a pace this market has never seen before? The answer is more alarming than you think. Welcome to Currency Archive. Now, if you've been around long enough to know that the first sign of a crisis is always buried in the data nobody's reading, then this channel was built specifically for you. Hit that subscribe button. Think of it like locking your front door before the storm hits. You wouldn't leave it open, so don't leave this one either. And before we go any further, drop in the comments. Where in the world are you watching from today? Because the people sitting in this audience right now are not average viewers, and I want to know exactly who's paying attention. Something is happening inside the most closely watched silver vaults in the world. It is not loud. It is not dramatic. There are no headlines, no emergency press conferences, no urgent warnings from the institutions that are supposed to be watching. But the data is speaking, and for those who know how to read it, what it is saying right now is deeply unsettling. Deep beneath the streets of New York City, inside the heavily secured vaults of the COMEX exchange, physical silver bars are moving, not in, out, month after month, week after week, at a pace that analysts who have tracked these markets for decades describe as unlike anything they have witnessed before. To understand why this matters, one must first understand what COMEX actually is, and what role it plays in setting the price of silver for the entire world. The COMEX, the commodity exchange, is the primary marketplace where silver futures contracts are traded in the United States. It is where buyers and sellers agree on a price today for silver that will be delivered at a future date. For decades, the prices discovered on this exchange have functioned as the global benchmark. When someone anywhere in the world wants to know what silver is worth, they look at COMEX. Inside this system, silver is stored in two categories. The first is called eligible silver. This is metal that meets COMEX quality standards and sits in approved vaults, but it has not been formally committed to the exchange for delivery. Think of it as silver sitting in a warehouse, available in theory, but not yet in the queue. The second category is called registered silver. This is the metal that has been formally designated for potential delivery against futures contracts. This is the silver that actually backs the paper promises being traded every single day. When a futures contract reaches its delivery date, registered silver is what gets handed over. And it is the registered silver number that is now alarming serious market observers. In September of 2025, COMEX registered silver vaults held approximately 200 million ounces of physical metal. That was already considered a relatively modest figure by historical standards. But it was functional. It was enough to maintain confidence in the system. Enough to suggest that when contracts came due, the metal would be there. Then the outflows began accelerating. By February 2026, just 5.5 months later, that number had fallen to 88 million ounces. To put that in perspective, 111 million ounces is not a rounding error. It is not normal seasonal adjustment. At an average depletion rate of 20 million ounces per month, the registered vault supply has been hemorrhaging at a pace the market was never designed to sustain. Now here is where the story becomes genuinely serious. The COMEX system requires approximately 30 million ounces per month in registered inventory flow to function with reasonable stability, to meet delivery obligations, maintain market confidence, and allow the futures pricing mechanism to operate with integrity. The current depletion rate is running at 15 million ounces per day during roll periods. The math does not balance, and when the math does not balance in a system this large, something eventually gives. Some voices inside the industry point to eligible silver as a buffer. They argue that metal sitting in the eligible category can be transferred into registered holdings when needed, that the total vault picture is not as alarming as the registered figures alone suggest. But here is what those voices are not telling the full story about. That transfer process from eligible into registered has already been happening. It has been happening for months, and it has still not been enough to stop the decline in registered holdings. The buffer is being used, and the drain continues anyway. Something is pulling silver out of New York faster than the system can replace it, and that there's an old principle in market intelligence that serious analysts have quietly followed for generations. If you want to understand where money is truly flowing, do not watch what institutions say, watch what they pay. Because price premiums do not lie. They do not spin narratives. They do not hold press conferences. A premium is simply the market's honest confession, a signal that someone, somewhere, wants something badly enough to pay more than the stated price to get it. And right now, Shanghai is confessing something extraordinary. While New York silver sits at $7,700 per ounce on the spot market, Shanghai is trading physical silver at $86 spot and $88 on futures. That is a $90 premium, sustained, consistent, unmoved even during the Chinese New Year market pause, a period when most Asian commodity markets slow dramatically and price gaps typically narrow. This premium did not appear overnight. It has a history, and that history tells a more complete and far more alarming story than the number alone. In the earlier months of this cycle, the spread between New York and Shanghai silver pricing was approximately $3, noticeable to experienced traders, interesting to analysts, but not yet screaming. Then silver moved. As physical demand began overwhelming paper supply signals, silver crossed $120 per ounce. And as it did, the spread did not close. It widened, dramatically, all the way to $18 at its peak. Think carefully about what that means. At the precise moment silver was rising in price, the premium that Shanghai buyers were willing to pay above that rising price was also increasing, simultaneously, in the same direction. That is not speculative buying. That is not momentum trading. That is institutional accumulation under urgency. To understand the mechanics of what is happening, one must follow the arithmetic that is quietly driving silver across the Pacific Ocean. Shipping physical silver from New York to Shanghai costs approximately $2 per ounce when insurance and logistics are factored in. With a $9 premium on offer in Shanghai, that leaves $7 of pure margin on every single ounce successfully delivered. $7 per ounce on a commodity trading at $77. That is a 9% guaranteed return on a single physical transfer, before any market position is even considered. In a world where institutional investors spend years constructing strategies to generate 7% annually, a 9% arbitrage on physical delivery is not an opportunity, it is an instruction. And the market has been following that instruction with remarkable discipline. Silver has been loaded, shipped, and delivered into Shanghai at a pace that explains precisely why New York's registered vaults have been losing 20 million ounces every single month. The drain in New York and the premium in Shanghai are not two separate stories. They are the same story, told from opposite ends of the same pipeline. But here is where the analysis moves from interesting to genuinely significant. Chinese demand for physical silver is not being driven purely by investment appetite or industrial necessity alone, though both of those forces are substantial and accelerating. There is a third buyer in this market, one that operates without price sensitivity, without quarterly earnings pressure, without any meaningful constraint on budget. China's military-industrial complex has become what serious commodity analysts are now describing as an insatiable silver consumer. Solar energy infrastructure, advanced electronics, precision defense manufacturing, next-generation communication systems, all of it requires silver. All of it is being built at a scale and speed that commercial markets were never calibrated to supply. And unlike a hedge fund that exits when the trade gets crowded, a sovereign industrial buyer does not exit. It simply continues buying at whatever premium the market requires. This is the part of the Shanghai signal that most Western financial commentary has failed to accurately price into its analysis. The $9 premium is not a temporary inefficiency waiting to be arbitraged away. It is a standing bid from a buyer whose demand does not respond to price the way conventional market theory assumes. And as long as that bid remains open, silver will keep moving east. New York will keep losing registered inventory. And the gap between what the paper market says silver is worth and what Shanghai is actually willing to pay for it will keep telling a story that the official numbers are not yet ready to admit. There's a magician's oldest secret. The trick is never in the hand the audience is watching. It is always in the hand they are not. For decades, the global silver market has operated on exactly this principle. And for decades, it has worked flawlessly. Prices have been managed. Narratives have been controlled. And the vast majority of market participants have watched the hand they were shown, the COMEX futures price, without ever questioning what was happening in the hand being deliberately kept out of sight. But magicians make mistakes when they are rushed. And right now, the silver market's oldest illusion is showing its first visible cracks. To understand what is fracturing, one must first understand how the illusion was built. The COMEX futures market trades an extraordinary volume of silver contracts every single day. These contracts represent promises, agreements to buy or sell silver at a specified price on a future date. On paper, the volume of silver represented by these contracts dwarfs the actual physical silver that exists in COMEX vaults by an enormous margin. This is not a secret. It is simply how futures markets are designed to function. The assumption embedded in the system is that the overwhelming majority of these contracts will never result in actual physical delivery. Most traders will close their positions before the delivery date arrives, rolling forward, taking cash settlement, or simply exiting the trade. Physical delivery is the exception. Paper settlement is the rule. And as long as that assumption holds, as long as the percentage of traders actually demanding physical silver remains small and manageable, the system maintains its integrity. The paper price and the physical price stay close enough together that no one asks uncomfortable questions. But that assumption is now under direct assault. Consider what is currently happening inside the COMEX March contract roll period. When a futures contract approaches its delivery date, traders who do not intend to take physical delivery must roll their position, closing the expiring contract and opening a new one further out on the calendar. The volume and pace of this rolling activity is one of the most reliable indicators of genuine physical delivery stress in the system. Normal roll activity for a functioning silver market requires approximately 30 million ounces per day to move efficiently through this process without creating delivery bottlenecks. Current roll activity is tracking at 15 million ounces per day, exactly half of what the system requires. This is not a rounding error. This is not a temporary technical anomaly that will self-correct by next Tuesday. This is the futures market's own internal mechanism, signaling that the relationship between paper contracts and physical backing is under serious strain. When roll activity collapses to half its required pace, it means one of two things. Either the traders holding contracts are finding it increasingly difficult to exit cleanly, or a growing number of them are not trying to exit at all. They are staying in, waiting for delivery. And a market built on the assumption that almost nobody takes delivery is not designed to handle a world where that assumption is changing. Now layer onto this another data point that arrived with almost no mainstream commentary. The United States Federal Reserve recently injected $18.5 billion in overnight repurchase agreements, overnight repos, into the financial system. This was the fourth largest such injection since the COVID crisis of 2020. Overnight repos are emergency liquidity tools. They exist to prevent short-term funding markets from seizing. When the Fed deploys them at this scale, it is not a routine maintenance operation. It is a signal that somewhere in the plumbing of the financial system, liquidity is under pressure significant enough to require immediate intervention. The timing of this injection, arriving precisely as COMEX silver delivery stress is accelerating and Shanghai premiums are holding firm, is not something that serious analysts are treating as coincidence. Liquidity injections of this magnitude have historically preceded periods of significant commodity market dislocation. The Fed is not injecting $18.5 billion because the system is healthy. And yet, through all of this, the official COMEX silver price continues to trade as though none of it is happening. $77 per ounce, calm, orderly, unremarkable. This is the illusion still holding its shape on the surface, but beneath that surface, the eligible vault silver that was supposed to transfer smoothly into registered holdings and replenish the system has been transferring, consistently, for months. And it has still not been enough. The buffer that defenders of the current system point to as evidence that everything is fine has been deployed actively, continuously, and registered holdings have declined anyway, from 200 million ounces to 88 million, with the drain still running. There's a moment in every structural market failure when the gap between the official narrative and the observable reality becomes too wide to paper over. History has recorded these moments before, in the London gold pool collapse of 1968, in the Hunt Brothers silver crisis of 1980, in the nickel market suspension on the London Metal Exchange in 2022 when prices moved so violently the exchange simply halted trading and canceled contracts to protect institutional players from losses the system could not absorb. In every single one of those episodes, the warning signs were visible in the data weeks and months before the public event. The analysts who read those signs early did not predict the future through intuition or speculation. They simply refused to watch the wrong hand. The paper market illusion requires one fundamental condition to survive. It requires that physical silver remain available. Wars are rarely declared. They are recognized, usually long after the first strategic moves have already been made, long after positions have been established, long after one side has quietly secured what the other side has not yet realized it needs. The most consequential economic conflicts in modern history did not begin with headlines. They began with procurement orders, shipping manifests, vault withdrawals, premium bids placed in markets that most analysts were not watching closely enough to understand what they were actually seeing. What is happening in the global silver market right now fits that pattern with uncomfortable precision. This is not a price anomaly. This is not a temporary supply disruption that will normalize when the next quarterly report arrives. This is a supply war, and one side entered the battlefield considerably earlier than the other. Step back from the individual data points for a moment and look at the complete picture they form together. New York's COMEX registered vaults have lost 111 million ounces of physical silver in 5.5 months. Shanghai has maintained a $9 premium above Western spot pricing consistently, even through a major national holiday period when most commodity markets pause and price gaps narrow. The COMEX March roll is functioning at half its required pace. The Federal Reserve has deployed its fourth largest overnight liquidity injection since COVID, and the eligible silver buffer that was supposed to absorb delivery stress has been actively transferring into registered holdings for months without stopping the decline. Each of these data points, viewed individually, can be explained away. Together, they describe a single coherent event. Physical silver is being systematically removed from Western market infrastructure and repositioned inside Chinese-controlled supply chains, and it is being done at a pace and scale that the Western pricing mechanism was never designed to withstand. The strategic logic behind this movement is not difficult to follow for anyone willing to trace it honestly. China's industrial demand for physical silver is not discretionary. It is not a portfolio allocation that gets reviewed at the end of the fiscal quarter. It is structural, embedded into the architecture of the nation's most critical long-term priorities. Solar panel manufacturing at the scale China is currently executing requires silver in quantities that would have seemed extraordinary even a decade ago. Advanced semiconductor production, fifth and sixth generation communications, infrastructure, precision defense systems being developed and deployed at sovereign scale. Every one of these sectors consumes silver. None of them have viable substitutes, and all of them are being expanded simultaneously, not gradually, but aggressively, as part of a coordinated national industrial strategy that operates on decade-long timelines rather than quarterly earnings cycles. When a buyer of this nature enters a commodity market, they do not behave like a hedge fund. They do not take profits when the trade becomes crowded. They do not reduce exposure when prices rise. They simply continue acquiring, because the alternative to acquisition is a slowdown in strategic national programs that no government official is authorized to permit. This is what makes the current supply war structurally different from previous commodity squeezes. The demand driving silver eastward is not speculative. It is not cyclical. It is sovereign and structural, and it will not reverse when sentiment shifts. Now, consider what this means for the Western market infrastructure that currently sets the global price of silver. COMEX Price Discovery Authority rests on a foundational assumption that the exchange holds sufficient registered physical silver to credibly back its futures contracts and maintain orderly delivery when demanded. That credibility is not just a technical requirement. It is the source of every price signal COMEX sends to the world. When registered holdings stood at 200 million ounces, that credibility was intact. At 88 million ounces, with a depletion rate of 20 million per month, that credibility is on a clock. If current outflow rates continue without a dramatic reversal in physical inflows, COMEX registered silver approaches critical threshold levels within weeks, not months, weeks. At that point, the exchange faces a choice that no futures market wants to confront publicly. It can source physical silver at whatever price the market demands to replenish registered holdings, which would require acknowledging that the current paper price is significantly below real physical value. Or it can restrict delivery, which would be a direct admission that the paper contract system is no longer fully backed by the physical metal it claims to represent. Neither option leaves the current pricing illusion intact. For the business community watching this unfold, the strategic implications deserve serious and immediate attention. 3 specific signals will determine whether this supply war escalates into full market dislocation or finds a temporary equilibrium. The first is the rate of COMEX registered vault change over the next 30 days. If monthly outflows remain near 20 million ounces, the timeline to critical threshold accelerates. If inflows begin meaningfully reversing the trend, it suggests Western institutions have begun responding to the pressure with physical procurement of their own. The second signal is the Shanghai premium trajectory. A premium that widens beyond $9 indicates Chinese demand is intensifying faster than arbitrage flows can satisfy it. A premium that begins compressing toward $5 or below suggests the pipeline of Western silver moving east is beginning to slow, either because Western vaults are running low enough to restrict outflows or because Chinese strategic reserves have reached a temporary saturation point. The third signal is Federal Reserve liquidity operations. Another overnight repo injection at or above the scale of the recent $18.5 billion deployment, particularly if it arrives in close proximity to a COMEX delivery date, would indicate that financial system stress and silver market stress are no longer 2 separate conversations. When those 2 conversations merge into one, the market event that follows will not be quiet. History does not repeat in identical form, but it rhymes with remarkable consistency. In 1968, the London gold pool collapsed because a small number of nations quietly demanded physical gold delivery faster than the pool could supply it. The official price held until the day it did not, and when it broke completely. In 1980, The silver market's encounter with the Hunt brothers ended not because their strategy was wrong about physical scarcity, but because the rules of the exchange were changed mid-game to protect the institutions on the other side of their position. The question serious analysts are now asking, quietly, carefully, and with considerable professional caution, is which of these two historical templates the current situation most closely resembles? A structural break driven by physical exhaustion, or a rule change designed to protect the paper system from the consequences of its own contradictions? What is certain, regardless of which path this takes, is that the silver market the world wakes up to on the other side of this episode will not look identical to the one that existed before it began. The vaults are draining, the premium is holding, the paper